One of history's greatest investors, Peter Lynch, in an exclusive interview unravels strategies on how to navigate today's dynamic markets in 2023. Peter Lynch has an impressive track record of 13 years, turning the Magellan Fund of $20 million into $14 billion by the time he retired in 1990. He also teaches people about investing through his old speeches and books, and it's a big deal when he gives an interview because he rarely does. In this video, we'll look at what Peter has to say and his 2023 investment strategies. In a recent interview, Peter Lynch talked about the economy, the collapse of banks, and how you should invest in 2023. Peter is the vice chairman of Fidelity Management, a company that helps people manage their money. He's really smart about picking stocks and has a strategy that works well. Let's hear what Peter has to say on stock picking and buying what you know.
People, they're investing in individual stocks. It's sad they're careful when they buy a refrigerator or an airplane flight. They're careful with their money, and they'll hear about a stock on the bus, and they'll put $5,000 or $10,000 on it. They have no idea what they do. So you're really got to be careful. Look at the company, look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason.
Peter advised checking a company's financial health and understanding why its stock should go up. He suggested looking for companies that are improving or growing, like Panera or Family Dollar. He pointed out that sometimes unexpected companies like TJX, Analog Devices, or NVIDIA can increase in value a lot. Peter Lynch's book, One Up on Wall Street, is a great resource for beginners who want to understand stocks and being a shareholder. During his time as the leader of Fidelity's Magellan Fund from 1977 to 1990, the fund performed exceptionally well, with an average yearly return of 29.2%. This was more than twice as good as the S&P 500 index. Peter Lynch is famous for advising regular investors to invest in things they are familiar with. This approach can help you avoid many mistakes and increase the likelihood that you'll stay invested even during market downturns. Lynch's strategy revolves around sorting stocks into 6 clear categories, each with its own set of risks and opportunities. As an investor, it's crucial to identify the category a stock falls into before considering buying it. This helps you make informed decisions. Before we dive deeper, make sure to hit that like button and subscribe to this channel for more incredible life-changing content. Now, let's move on. Lynch's stocks, 6 categories. 1. Fast growers. The first category is the fast growers. They're often small and bold and challenge norms in their industry. Their growth rate is high, above 20%, and they bring fresh ideas. They can boost portfolio returns with big wins. Fast growers can be tempting for investors with big returns, but they're also very risky. They lack solid funds and can fail before succeeding. The market values them highly, especially in low interest times, which can make them pricey. If they slightly miss growth expectations, their stock price drops. Tesla, a fast grower, faced cash problems, was seen as costly, and grew super fast. This growth was impressive even in the car industry, which usually has ups and downs. Spotting a fast grower is tough. They might look costly due to expected growth. Telling the good from the bad is hard. But getting a true fast grower in your investments can raise your returns hugely. For instance, if you put money in Google in 2004, you'd have gained nearly 50 times your investment. Since fast growers are risky, Lynch suggests having few in your portfolio. Managing this risk is key. If some fail, it won't hurt too much. 2. The Stalwarts. Stalwarts are strong, well-established companies with more growth potential than slow growers. They're tough and steady, even in tough industries. Stalwarts are usually big and stable, growing at a moderate pace of 1 to 10%. They're good in hard times and don't lose value. They often pay dividends, and because they're big and steady, they're safer. They give stable returns and help keep your investments steady. A classic example of a stalwart is Coca-Cola. Despite the competition, it's consistently earned good returns for 20 years, thanks to its strong brand and wide distribution. Fast growers often turn into stalwarts, like Starbucks. It grew fast in the past, slowed down, but remained stable. Lynch's advice for stalwarts: keep them in your portfolio. Don't trade. They're tough in tough times. When you find a reasonably priced stalwart, follow Lynch's buy and hold idea. Avoid watching the news or stock prices too often. Buffett got Coca-Cola and American Express years ago and still keeps them. Stalwarts need occasional checking to ensure they're doing well, and they might become slow growers. 3. Slow growers. Peter Lynch isn't a fan of slow growers. They're well established but have minimal growth, just a bit more than inflation. They're stable and good for income-focused investors, with fewer ups and downs compared to smaller companies. They're leaders in their field, but can't expand much. They're low risk, but offer low rewards too. They're predictable and easier to understand. Slow growers are companies with slow earnings growth. They're big and work in markets with few chances for growth. Imagine marathon runners settling into a slower pace after a quick start. Procter & Gamble, British American Tobacco, and Altria are examples today. Even though they grow slowly, they often pay dividends. Some improve with changes. Lynch advises removing slow growers from your investments, as they don't help much in the long run. 4. Turnarounds. Turnarounds are companies that were once popular but fell on hard times. People invest in them hoping to buy low and make money when they recover. These companies used to be favorites, but struggled due to management issues, financial problems, or shifts in the market. The hope is that they'll change how they work and get better, but this comes with high risk and reward. Chipotle Mexican Grill is an example of a successful turnaround. When CEO Brian Niccol took over in 2018, the company was struggling due to food safety issues. Niccol introduced changes and the stock price quadrupled in the next 5 years. Peloton is another case, trying to turn around after growing too fast during the pandemic. Zillow is also recovering from a failed home buying program. However, Lynch advises against investing in turnarounds. These situations are uncertain and often don't work out. Successful turnarounds usually involve powerful investors who can make changes in the company's management or direction. As a regular investor, you're unlikely to have that level of influence, making investing in turnarounds quite risky and not recommended for passive investors. 5. The cyclicals. Cyclical companies are those whose sales and profits go up and down with the economy's cycles. Industries like steel and chemicals are classic examples of these kinds of companies. When the company is doing well, the demand for their products increases because of strong construction and manufacturing activity. However, when the economy is slow, their sales and profits tend to decrease. These companies follow predictable patterns, growing or contracting with the economy. They're found in various industries, from airlines to manufacturing. Their profits change depending on the economy's stage. Successful investing in cyclical requires predicting economic trends accurately, so you can buy low and sell high. Mistiming can lead to big losses. Ford, for example, loses value in bad times. Lynch says cyclical investing isn't for beginners. It's complicated and risky. Experienced investors do well here. Without lots of knowledge, timing your buys and sells can be hard. 6. Asset plays. Asset plays are companies that own assets that the market doesn't fully recognize. These assets can include cash, real estate, investments, patents, and trademarks. The company's stock price doesn't reflect these assets, which gives investors a chance for big gains when the market realizes their true value. Warren Buffett made a name for himself doing this, buying stocks for less than what the company had. Asset plays exhibit distinctive characteristics, possessing undervalued assets such as overlooked items, sometimes encompassing substantial land assets not reflected in stock prices, as well as intellectual property like patents or technology. The process of identifying asset plays requires a thorough analysis of a company's balance sheet and its entirety, demanding patience for the market to recognize value, potentially leading to acquisition interest from other entities drawn to their undervalued holdings. An example is a company with a lot of cash worth more than its market value. Even if it's losing money, the assets make it safer. Tech companies with patents are another example. When they're used, the value goes up. Lynch's strategy is to see hidden value early. Once found, wait for the market. It can take years, and research is key. But this can be risky. If the market never sees the assets or the company messes up, it's bad. So, while rewarding, it needs understanding and patience. The performance of different stock categories is influenced by changes in the overall economy. Economic conditions play a significant role in shaping the outcomes and trends within various stock sectors. If you find this video informative, like and subscribe to this channel for more educational content. Let's continue. Apart from just figuring out which category a stock falls into, Lynch provided a list of things to check before investing in a stock. These are the factors that can make a stock worth considering. Balance sheet. Check a company's balance sheet to see if it can handle upcoming economic changes. For example, Apple's 2022 balance sheet had $99.6 billion in long-term debt and $9.7 billion in short-term debt. They had $20.5 billion in cash, $30.8 billion in short-term securities, and $114 billion in long-term securities, which can be turned into cash during tough times. Calculating net debt, 110 billion debt minus 165 billion cash equals 55 billion net debt, meaning Apple's cash exceeds debt. Lynch suggests investing in companies with strong balance sheets like Apple's, as they're stable. Understanding balance sheets is vital for investing wisely. Bottom-up approach proponents like Warren Buffett and Peter Lynch believe that undervalued exceptional companies can always be found, even in uncertain economic times. This approach involves investing in self-reliant companies with growth potential, regardless of their industry's health or the overall economy. The key is identifying strong companies that could outperform the market. When fundamental factors are solid, bottom-up investors choose such companies irrespective of industry trends, making this approach effective for selecting quality stocks. The top-down approach starts by looking at the overall economy and then narrows down. There are 3 steps. First, check if the economy is good for stocks. Second, see how industries are doing. And third, pick stocks accordingly. Top-down followers like Ray Dalio think the economy and industry affect stocks, so they analyze both to choose securities for their portfolios. Earnings. Another factor is to examine earnings and seek stable, consistent, and rising growth. Valuation should be towards the lower end of its historical average. High net cash per share compared to the share price is important. Unique growth cases. Identify firms with rapid growth in stagnant industries. They offer products people consistently buy regardless of economic conditions. These companies leverage technology but aren't tech-focused, making them less prone to disruptions. Look for unattractive but good companies. Factors of unattractiveness include a dull company name, being in a mundane industry, engaging in disagreeable or gloomy activities, or facing negative rumors. These aspects make many investors avoid the stock, leading to good opportunities to buy at lower prices. These insights offer a solid foundation for your investment decisions. Make sure to stay connected by liking, sharing, and subscribing as we bring you more expert interviews and valuable financial guidance. Keep an eye out for our upcoming content.